Okay. Good day, everyone. We are here to continue from where we started. Okay, we got to profit planning. So yeah, I just quickly have to do then we move on. So yeah, profit planning is basically like telling me how much profit you can earn based on output. So yeah, determining sales volume or output level to achieve a target profit, assuming operating cost remains constant. Okay, entails revenue planning, cost planning, and accounting for the effect of income taxes when planning for the desired profit after tax. When planning for a targeted profit, operating profit, or before tax profit must be used. As I said in the introduction, my favorite video, I spoke about this one. Always use the profit before tax. Anytime you profit after tax, you have to net it off or gross it up. Okay, see. Net profit or profit Net profit or after-tax profit must be grossed up. That this is a format for grossing it up. Profit before tax equals profit after tax divided by 1 minus the rate given to you in the question. So assuming they give you, let's assume they give you a net profit in the question or a profit in the question, and they didn't tell you that this is what profit after tax. But in the question, you see a tax percent in that particular question. That means it's a profit after tax. Because definitely they want you to know that um, based on the tax rate given, you have to know that this was a profit before, profit after tax, sorry. But sometimes they can give you the profit, the tax rate, and it will give you a profit before tax. So you have to watch out for the question. This part is very confusing. Okay. Okay, so let's move on. So yeah, this is the format. It's almost the same as the one we did. Okay, we just add, just with the fixed cost, we only add what's called the profit plan to it. That's it. So yeah, total fixed cost plus uh tax profit, budgeted tax profit divided by contribution margin or contribution. Sales revenue the same thing. Take this one, PPQ times SP per unit. Then come to yeah, using here's a contribution margin approach. So yeah, TFC plus those budgeted targeted or profit divided by the contribution margin ratio. So with the same example, let's just time calculating a bit. So here we know we calculated and we had our break-even point in units to load. Our BEP in units was what was it? It was 3,000. Yeah. By year, because of profit planning, okay. So, so what would be the revenue rate? Because you are doing based on the target profit, we use target profit in units. Units needed to meet our target profit. Okay. Target profit in units. Okay. It simply equals you take out fixed cost plus our what targeted budgeted target profit given to us in a question divided by what contribution or contribution margin. So here we just take our fixed cost, also our fixed cost, this is so 84,000. Then add our target profit, give it to us in the question. That's this one, 14,000. Then we divide it by our what contribution, that's 28. So this is 3,500. That's the unit we need to get in order to achieve our profit, targeted profit. So what of target profit and revenue? I mean, we've done it already. So we just take this one, just take the unit figure and multiply it by the selling price, and we know our selling price is what 70, so you just multiply it and you get this one. So you see the difference. You see the difference here. So these are the difference. Okay. So we've done this one. We'll be able to go. Okay, yeah, this is the equation approach. Sorry. So let me teach you the what's it called? The contribution margin approach. Okay. So with that one, our targeted profit in units is the same. It's always the same. That was 85,000. Then it changes when it gets to the revenue part. So targeted profit and revenue equals what? This one equals, we've already done the format already. So here equals what? Fixed cost plus our targeted profit. Put it into bracket. Then we divide it out our contribution margin ratio. And we did our contribution. So this plus this will give us what? So I'm coming. So let's assume our fixed cost plus what's our fixed cost? Our fixed cost plus the fixed cost plus our what? Target profit. Our fixed cost and our target profit. What's our fixed cost? Fixed cost was 80,000, 84,000 also, 84,000. Then we add our target profit of 14,000 and 8,000. So here we know our what CMR we calculated for it. Don't forget to visit. It's 0.4. Yes. So then bring it here. Income receipt. So here we just simply put before I done this one here. So you take this figure divided by this figure. And voila, here we are. Okay. So I think we are almost done. So okay, that's it. That's it. So this is the last one. Okay, this okay, let's do it first. So here, assuming tax rate of what 20%. Okay. So here, using the equation approach, okay, so our equation approach, you can say it's the same thing. Target profit in units. Already done the format here. So here equals fixed cost plus targeted profit. That's the targeted profit given to us. Sorry, divided by our contribution margin. But here, our target profit, we have to gross it up. So target profit our target profit was 14,000 or yeah, 14,000. So we have to gross our target profit by what the rate given to us 20%. And to gross, so our gross our target profit equals our profit given to us, that's our profit after tax minus divided by bracket open 1 minus the tax rate given to us. Okay. So what's our profit? Was 14,000. 14,000 divided by 1 minus 0.3. You get it? So this is 17,500. So these are new target profits. So if we see that there's a difference between this 17,500 and the 14, which is what 3,500, which that's a component of the tax portion. Let's have the tax portion. So we added somewhere here, 3,005. Okay, it could be the same in this one also. So here, okay, let's do it fast anyway. So targeted profit in unit is simply equals our fixed cost, which is 4,000, plus our contribution targeted profit as 17,500 divided by remember, always remember, I didn't use the 14,000, I used 17,500 because that's after I taken a tax component out. This one given to us, we're assumed to be included with the tax component. We had to take it out. So after taking it out, that's what we had. So, so tired, stressful. Very our contribution margin. What's our contribution margin? Our contribution margin equals 28, the rest is to 5. So this one in units. So T, relative profit in value is simply equals this multiplied by the sales, which was, I think it was about 70 years. Yeah, so this is it. So this is the equation. So usually what the contribution approach. Okay. With the country, I always tell you that this is the same thing. This side is the same thing. The only side that changes is when it comes to the value side. So targeted profit value is simply equals this one, this cost plus targeted profit divided by contribution margin ratio. So here our fixed cost plus our targeted profit. What is it? So here equals our fixed cost was 84,000 plus our targeted profit of 17,500. Remember, not 14,000, 17,500. Because okay, divided by our contribution margin ratio, and we add our contribution margin ratio here, this side, because so this one, just put this figure. That's it. So the same thing. Okay, so thank you for staying with me, and hopefully tomorrow or next week we continue with the multiple product approach. Thank you very much. Bye bye.